Moving average analysis. Moving averages are one of the most versatile technical tools available, if you know how to use them. The accepted method makes them subjective as any other indicator, so we need to remove that. Our method is going to eliminate that subjectivity, as well as other indicators. Our goal is to keep our charts free of other indicators and allow us to focus on what really matters, and that's price. What we want from this indicator is a way to objectively speed up the analysis of the price action. The time frames and the moving averages that we're going to use. On a daily time frame, we're going to use the 20 and the 40, or the 50 if you like. The 50 is more widely followed. Part of the TPM1, we used the 40 period moving average. Right? The reason being it just trends tighter with the 20 MA. Our longer term moving averages are going to be the 100 and the 200 MA. And for those stocks that are in strong trends, it won't be necessary for us to use that 100 to 200 MA because price will be far from them. On the 60-minute chart, the 15-minute chart, and the 5-minute chart, we'll use the 20 and the 200 period moving average. We're going to define the intraday trend with the 60-minute time frame. That'll be our longer term measure. And then on the 5 and the 15-minute charts, these are the time frames that we're going to use for our intraday entry points that are in alignment with the 60-minute time frame. And then we'll use the 1 or the 2-minute chart with a 10 and a 20 MA, and we'll only use those to provide entries, provided that the time frames high are in agreement with that. So our basic moving average guidelines. I'm going to use simple moving averages. No other types are necessary. I mean, the exponential type or the weighted type. As I said, moving averages are subjective, and it's the price that we're really focused on, but the moving averages can smooth out the analysis for us and help to speed it up. Now, it really doesn't make a difference what type you use. We choose to use the simple period moving averages. We're going to use a 20 MA on all time frames, and we're going to pay attention to the slope of that moving average as an indication of trend strength. Now, the odds of a successful trade are in the direction of the 20 MA, or another way of saying it is trading in the direction of the trend. And if prices are above their 20 MA, odds are high that the trend is going to be up, and vice versa. If prices are trending below their 20 MA, odds are that the trend is going to be down, and rallies within a downtrend will be sellable. Converging moving averages are going to point to inflection points. Because we're using intraday the 20 and the 200 MA, there had to have been a decrease in volatility to bring those two moving averages together. As more and more prices consolidate in the generally the same area, those two moving averages will come together, and there should be an increase in volatility should be at hand. You want to keep the color volume moving averages in various time frames consistent, meaning your 20 period moving average should be the same color on all time frames. During the presentation, you'll see that the 20 MA is the color blue, and the 200 period moving average is the color red. So whether we're looking at the 60-minute chart or the 5-minute chart, those moving averages will still be the same color. And moving averages are guides that speed up the analysis process for us, and candles or prices what tell us what points are tradable. I'm going to keep the approach simple. A 20 MA and a 200 period MA. This will keep our chart uncluttered of any type of indicators and allows us to focus on support, resistance, candlestick patterns, and the moving average relationships. And we want to trade in the direction of that 20 MA and less extended. And we'll look at sideways corrections or time corrections into a rising MA as an alert point. So you note on the red circles where prices reach the 20 MA, At those times, we're looking for prices to begin to discontinue that sideways consolidation and resume the uptrend at that time. I said prices typically rally from that point when they reach a rising 20-period moving average. On this slide, we're looking at the moving averages converging, and you can see how the 20 MA reaches the 200 MA, and the 20 MA is sloping upward. So when the 20 and the 200 MA converge, we look for a rise in volatility. We pay attention to the slope of that 20 MA. Now, on the lower part of the slide, you can see the prices with the same moving averages, and you see the consolidation that was taking place. And as prices move sideways into the 20 MA, and note the small green bar there that closed on its high, right? As we go through the presentation, we'll talk about bars like these during consolidations that close on their highs. During a consolidation, you're often going to see price bars with tails on one or both sides of them, and then when we get a candle that closes on its high toward the end of the consolidation, that's going to be our signal point or attention point that says that prices should start to move in the direction of the trend at that time. When prices close at the high of the bar, that signals that there was strong demand until the end of that time period, and it should continue into the next. So when prices had moved under the 20-period moving average, it tells us that the supply-demand relationship has changed. Now, when we see prices moving under the 20 MA, we then have to look to the left and see if prices actually move under an area of support. Or did they just move under the 20 MA and not violate any support? Now, on this slide, we do see that a small double top had formed, and prices were moving down toward the next area of support. The 20-period moving average would be our analysis guide to pay attention to the relationship between those areas of support and resistance and if they are violated or not. As we're looking at our moving averages, we're going to look at the relationship between them and the relationship between price and those moving averages. We're going to use them for an overbought, oversold indicator. We're going to use them for a bullish and bearish divergence indicator. We'll use them as guides to support and resistance, to help us anticipate where a reversal may occur, for risk reward, and relative strength. We're going to come to conclusions on all of these just by looking at the relationship between these moving averages and the moving averages in price. Overbought and oversold indicator, we're focused on the distance between the 20 MA and the 200 MA. The further they move apart, the greater the odds of a reversal is increasing. The further prices move away from the 20 MA, and the odds of reversal are increasing. And what we're really doing here is using the MAs to speed up the analysis, and then we have to look at actually the distance between current prices and prior price congestion. Again, as the speed of price begins to accelerate in one direction, those price bars will be moving further and further away from the moving averages. Remember, the moving averages by definition are averaging out the prices from the past in relation to current prices. Well, the fact that we're using a 20 MA and a 200 MA, they cannot move as fast as current prices. So as prices accelerate away from the moving averages, they're going to be moving away from prior areas of price congestion. And this is the essence of climactic type of buy and sell setups. For prices to be far from the 20 MA, right, what we're looking for is our prices far from price congestion. The further they move from that price congestion, once a reversal occurs, the odds of increase of prices retracing back up toward that congestion. Now, being overbought or oversold doesn't mean a reversal will occur. It's only suggesting that the odds are increasing. These terms are subjective, and we want to be careful of the thoughts that they produce. When we say that a particular stock is oversold, it brings about a thought of the stock is ready to bounce. And that may or may not be true. Right? We have to look at the distance that prices are from prior congestion. Is it in an area of price support? What is the pattern of that time? Stocks that are oversold often become more oversold. So just because you perceive a stock of being oversold, it doesn't mean it's going to start to move higher. Now, when we look at this through the eyes of an indicator, you can see the 14-period RSI on the bottom of the chart was basing at a lower level as the stock continued to move down. It moved sideways, up a little bit, and continued to move down again. So the oscillator gives us little information there, whereas the moving averages are constantly interacting with current prices. Are prices staying below the 20 and the 200? Or have they moved above the 20-period moving average? Are they still below the 200? Have they gotten above both moving averages, and so on? The information continually updates as more price bars form, and we look at the relationship between the current prices and the moving averages that we're using. A momentum or bullish-bearish divergence indicator. What we're looking for is once a changing of the guard forms after a new high or a new low, accompanied by a smaller distance between prices and the 20 MA, this is going to signal a slowing in momentum or a divergence. On the slide, you see the distance to the 20 MA noted by the red line with the arrows, and then after it made a new low and a changing of the guard, there was a shorter distance to the 20 MA. In other words, as prices broke down to a new low, the momentum slowed down. And this is what oscillators are doing as well. They're looking at the current prices and then looking at some price point in the past based on the parameters that you're using. And they're saying, as prices are moving down, in this case, making new lows, right, how much momentum was there on the continuation breakdown? And what we see is there was one bar moving down, you note where it says new low divergence with the arrow, and then a changing of the guard. So on that new low, there was one bar moving down, whereas on the prior low, there were multiple bars moving down. That's the simplicity of understanding price movement versus using indicators. Another way of visually noting divergences would just to take note of the distance between prior lows in a downtrend and new lows. As the lows get closer together, the momentum is slowing. Right? So, and we can do this analysis even without the moving averages, but it helps speed up the analysis for us. That's why we call them visual aids. Right? And you can look at the distance between the current prices and the moving average after a new low in a downtrend, or just look at the distance between the current low and the low that preceded it and the one prior than that. If the lows are getting closer together, the momentum is slowing down, and you're beginning to get what's known as a bullish divergence in a downtrend. Another exercise that you could do would be to put a 20-period CCI, RSI, Williams percent R, any type of oscillator on the bottom of your chart. And when you see the divergences in the oscillator, note the distance between prices and the 20 MA. This will help reinforce the concept that we're looking at here, slowing momentum based on the distance current prices are to a moving average. And we want to simplify the analysis process by removing technical tools that aren't necessary and for us to focus where we should be focused, and that's the price action. After all, that is what we trade. This concept of divergences is a deceptive one, and oscillators add to that deception. Divergences are showing you slowing momentum, but slowing momentum does not mean that the trend is going to change. Realize momentum slows down and it speeds up within a trend. We're looking at indicators like we have here on the bottom of our slide, this 14-period RSI. Note the red line indicating the downward sloping peaks while prices are moving higher. So while the momentum was slowing down, that did not mean that the trend was going to change. Note the size of the bars. Where prices started to move up from the 20 MA, the bars were larger. And then as it continued to move higher, the size of the bars or the ranges began to contract. So momentum was slowing down, but prices never even violated a prior bar's low by any significance and continued to go higher. And then momentum picked up again. Note the distance to the 20 MA where the green arrow is. As prices went sideways, they consolidated into the rising 20 MA, indicating that prices were getting ready to move higher yet again. Right? Remember, the trend was not violated. This was just a consolidation within an uptrend. And when prices made a new high, note the distance to the 20 MA, right? Noted by the red arrow. The distance contracted at that time. So prices made a new high. Note the small topping tail bar right at the high of the move, where prices made a new high from there and then began to consolidate again. And then once you get a bearish changing of the guard and prices began to move lower, we have a confirmed bearish divergence or slowing in momentum, and where prices had made a new high and then began to retrace again. Now in this instance, where prices moved under the 20 MA, we have a significant event here. Now, the moving averages speed up the analysis, but when we look to the left, what we see is that prices moved down and closed under that consolidation. So there was a violation of support, and now we have the beginnings of a trend change. A guide to support and resistance. Here's another way of using moving average in the proper way. We're looking for the moving averages to be in alignment with actual prices. Moving averages should point toward an area of support or resistance. When the moving averages are not in alignment with areas of support and resistance, they're going to be less significant as a reference point. While moving averages like the 20 MA and the 200 MA are widely followed, they can become a self-fulfilling prophecy because enough traders are looking at them as references. But what we want to make sure of when we're using them as a reference is whether they're in alignment with actual price congestion or not. Now you can see the pullback here to the 20 MA was actually in alignment with price support. But that should provide a significant reference point where buyers should step up or anticipate where positions will be taken. And as prices, if they were to move up toward the 200 MA, right, we can see that's in an area of price resistance, that prior pivot high to the left. That's going to become a strong focal point that traders will be using to exit positions at that time. And so when we look at moving averages, whatever moving averages you may be using, look to the left and see if they are in alignment with prior areas of price resistance or price support. Price is an actual supply point. Moving averages are not. Remember, moving averages are subjective as a reference point of resistance. Always want to ask, is there an area of price congestion to the left of that moving average? In this example, you can see as prices moved up toward the 20 MA, the range of the candle bodies did contract, so momentum did begin to slow, but then prices pushed up above that 20 MA. There was no price congestion to the left of it. Okay? And as prices came up to the area of congestion noted in the red square, you see the momentum stalled again, and then prices began to pull back again. Anticipate entry, exit, and risk reward. As prices pulled back to the 20 MA, look to the left, it wasn't an area of price support. We get a changing of the guard, and we would note this as a potent changing of the guard. It closed up near the high of the prior red bar and actually took out the high of it. This signaling that prices should begin to move higher. Now look at the distance between the 20 MA and the 200 MA. This is a visual aid that tells us that there must have been a sharp decline at some time, and there should be a price void because the 20 MA and the 200 MA are far apart. Now as we look at the price chart here, we note that prices had moved up and moved into that prior area of congestion or that consolidation over to the left. So this correction from that first point of resistance, meaning as prices corrected into that congestion to the left, it absorbed some of that supply. It made it less potent as a reference point of resistance. So as prices pulled back and formed the pivot high, as prices moved down toward that 20 MA and that potent changing of the guard formed, this is a pattern suggesting that prices could take out that pivot high and that the area of congestion to the left, the base, was going to be less of a concern to us. And once we enter that, we're going to be focused on this pivot high as our first reference point of resistance, whether prices can overcome that. And if prices can continue to move above that level, we'll look for them to move up toward that 200 MA, which is in alignment with that prior price high, as a reference point to exit our trade and take profits. A relative strength indicator. Before I continue with the explanation of this slide, I want to make sure that you do realize that the chart on the left is the one that we've been looking at through this presentation of slides on moving averages. Note the move up off of the low, the divergence at the low, the pullback to the 20 MA, the potent changing of the guard, and the subsequent move higher toward the 200 MA where the topping tail bar formed and prices then pulled back from there. Now, as we compare the moving averages of a stock or an index to another, it's going to tell us which is stronger. Essentially, what we're looking at here is the trends. And again, moving averages are visual aids. They're not really support and resistance. They do not really define the trend, but they do help speed up the analysis process for us if we know how to use them properly. Okay? So by looking at the trend of one stock to another, or comparing one stock to an index, we'll see which one is showing relative strength or relative weakness. So the stock on the left, what we're looking at is the distance at the low of the stock on the left was smaller as it made a new low to the one on the right. Note the one on the right was falling sharply at that time, whereas the one on the left was going sideways and then made a slight new low, so it was showing relative strength, moving sideways, while the other stock was moving down. When it began to rally, it rallied more sharply and moved further away from its 20 MA, whereas the one on the right moved slower and had a shorter distance to its 20 MA. And moving averages will help speed up the analysis process that we could really do without. And we'll cover this more in another section when we focus on relative strength. Moving average trend guidelines for day trading. Long positions are going to be favored when prices are above their 20 MA on the 60-minute chart. In other words, the 60-minute time frame is in an uptrend. And then we're going to look for pullbacks to find entry points on the 5 or 15-minute charts. We'll look for short positions when prices are moving below their 20 MA on the 60-minute chart. Or in other words, the trend is down on the 60-minute chart, the longer time frame, and look for entry points on the 5 and the 15-minute chart. So we're looking for a longer time frame to give us our bias, the direction of the trend, and then looking for a smaller time frame where the patterns are in alignment with that longer time frame, suggesting a continuation of that longer term trend. Now, when prices are extended below their 20 MA on the 60-minute chart, we'll look for long positions, or only at a time when prices have moved above their 20 MA on the 5-minute chart. In other words, we're looking for climactic type buy setups on the 60-minute chart. The longer time frame has gotten extended away from price resistance, but we're waiting for a time where we have seen stabilization on the time frame that we're trading in, the 5-minute, and we're using the 20 MA as a guide to that stabilization. Short positions will be considered when prices are extended above their 20 MA on a 60-minute chart. In other words, prices have accelerated on the 60-minute chart or have formed climactic type sell setups, but we're waiting for that momentum to stall and prices to move below their 20 MA on the 5-minute chart, signaling that enough momentum has stalled, the trend has begun to reverse, and I can find a signal or a setup on the 5-minute chart indicating that prices should pull back into the price void that was created on the 60-minute chart. The 60-minute chart is our long-term intraday chart. And when prices are declining below their 20 MA, we'll favor shorts. Note the red arrow pointing down under the 20 MA. Note the wide range bearish bar breaking down out of the consolidation on the 60-minute chart. This created a price void on the smaller time frames, and as those smaller bars were consolidating at the lower half of that bearish wide range bar on this 60-minute chart, during those times where those 60-minute bars were forming there, we'd be looking for pristine sell setups or fail type breakouts on the 5 or the 15-minute charts, which would give us our signals that the trend should continue on the 60-minute chart. As prices stabilized and then regained their 20 MA on the 60-minute chart, right, we're now looking for long trades as the trend is turning up on the 60-minute time frame, and then we were looking for breakouts, pristine buy setups, and continuation patterns on the 5 or the 15-minute chart, since it was now in alignment with an uptrending 60-minute chart. Here we have an extended bearish trend or a climactic type of buy setup on the 60-minute chart. Look at the distance prices are at the low to the 20 MA. Look at the distance prices are to the 200 MA. Note the distance between the 20 and the 200 MA. This tells us that there is room to retrace back up into the price void above that was created by the acceleration of prices to the downside. The trend is still down on the 60-minute chart, so when we're going to trade against that longer-term trend, we want to be sure that it's extended away from price resistance. Then we look for the stabilization on the 5-minute chart, and prices moving above the 20 MA is our guide that that stabilization has occurred. And then we look for patterns indicating that prices should move higher within that time frame. In this example, we have a 60-minute chart that moved up sharply and created a price void, moving well above its 20-period moving average. The 5-minute chart is the data that was happening inside of that 60-minute chart. As prices were moving up on our 5-minute chart, there came a time where they broke down and moved under the price support on the 5-minute time frame and then began to consolidate and held in the area of the prior low. And as prices moved up toward the 20 MA, they then formed a topping tail bar and a potent reversal at that time, signaling that prices should begin to move lower. That topping tail and the potent chaining of the guard is forming a double top in that area. Prices are extended on the 60-minute chart. They have broken down on the 5-minute chart, this signaling a move lower. Now, as prices did begin to move lower, you see that they moved lower and then the momentum stalled. Right? Noting the arrows pointing to the left to the support on the 5-minute chart. They stalled and then moved lower again, down toward that prior low. Then as prices began to break lower from that point, note the wide range bar breaking down under the consolidation on the right side of the chart. That prices accelerated to the downside. At that time, where they entered the void, now there was a void of any reference point for traders to use as an area of support, so prices begin to accelerate to the downside. This is why prices accelerate when they do, because there is no reference point for anyone to trade off of. So prices then continue to move lower, and then once they reach a next reference point, we would then anticipate that prices would begin to stall at that time.
There's the charge there.
And your reference points are going to be directly to the left, not beyond. And we look at what's directly to the left of current prices as our reference point, and then as prices enter an area where there's a void of reference points, those are the times where we get into trade setups where prices tend to accelerate in the direction that we're trading. And there are those fabulous trades that move rapidly and give us profits very quickly. And the other thing to realize is that when you do have that price void, you do not want to exit that trade too quickly. And when we get into the trend section, we'll talk about the way to manage those trades and hold on to them for as much as possible. In this section, I've taught you how to use moving averages objectively and how to use them to speed up the analysis process. If used in the typically accepted manner, meaning using moving averages at actual support and resistance or actual signals of trend change, it often leads to confusion or misplaced trades. I'm sure you've all looked at moving averages at times where you thought prices should stop there and saw them continually moving right through them as if they weren't there and wondered how was that possible. And then at other times looked at moving averages and thought prices should get to them but never did. Why did that happen? Because it was the price congestion areas that were in play, not the moving averages.